Randy, let me know when you can see my screen here.
Yep, I can see the first page, the Tree Walk Consulting Inc.
Okay, perfect. Yep, that's what I wanted to show. Happy Monday, everyone. Thanks for joining us here on the QV AE presentation. So today's presentation, I'm going to kind of walk through the importance of equality of earnings, what goes into it, why we do it, how it's going to impact you guys in your transaction, whether through purchase price reduction, whether through understanding the business a little more, whether through a higher leverage in negotiations, and kind of where really like why do we get it done in small to medium transactions, right? I think large transactions, everyone understands why it's done, but small to medium, sometimes people think, you know, if it's a few $1 million, $4 or $5 million, $3 million, they don't need it done. But you know, I'm here to tell you that's probably the scenario where you want it done the most. So that's going to be the topic of today. If you guys have any questions, feel free to ask them throughout. If you guys have real life deal questions you guys want to ask me, feel free to do that as well. You know, I just want this to be more of a conversation, and you know, we have a smaller group today, so it's nice to have a little bit more of a chit chat and hear what you guys are looking at, what you guys are seeing in the market in terms of deals, and really if you guys have any questions on the financial due diligence side. So before we begin, just tell you guys a little bit about Tree Walk and what we do. So we're a mid-sized CPA firm, about 65 people. I lead the quality of earnings department and the mergers and acquisitions department. I think last year we did 55 transactions or 52 transactions, and that's just last year. And so, you know, over the course of the last 3 years, we've probably, you know, north of 120 and 130. And a lot of them, or I'd say 85%, are lower mid-market businesses, so businesses that you guys are probably looking at to buy. And then the other 10% might be a bit higher and, you know, in enterprise value. So usually our average range is in that $1 to $10 million, $1 to $15 million. And the largest one we do is, you know, are kind of closer to that $100 million range. So we see a lot of different industries, a lot of different markets, a lot of different acquisitions, and a lot of different deals, you know, nuances with deals. And so that's why I say if you guys have any questions, you know, obviously I know you guys are all probably looking to buy one business or two businesses. So it's different from a service provider who sees, you know, 1 or 2 businesses a week, basically, right? So if you have any questions, feel free to ask on that. As we get into financial due diligence, I just want to kind of understand and show you guys what goes into it. So really, financial reporting oversight. We want to help you guys understand what the business is doing from an accounting and finance function. How is it structured? Where are there risks? Where are there opportunities for fraud? Where are there opportunities for mistakes? And what you guys can do post-acquisition to really take that business to the next level from an overhead and backbone perspective, right? A lot of businesses you guys are looking at to purchase in the SMB world and lower mid-market, there's not a strong finance and accounting function. There's not a strong backbone when it comes to financial reporting oversight. So really, as part of our QV, we always look for opportunities for when you guys can go in there post-close, really clean things up and start to analyze numbers a little bit better. And I'll tell you guys a story. And you know, as you guys know, I talked a lot about the deals we do. And so I like to share real life examples and real life stories to help you better understand why this stuff is relevant, right? So financial reporting oversight, for example, if you guys are looking at construction businesses with work in progress, I can tell you almost with fair amount of certainty that 75% of those businesses are recording their work in progress wrong. And so what you're going to have is either understated or overstated EBITDA revenue figures. And really really what happened is, I'll give you, you know, we did a transaction maybe 2023 December where somebody had bought a business and they have work in progress and a construction based business. And so what was happening was the previous seller, they didn't allocate work in progress appropriately to certain projects, and they weren't capturing cost and revenue on a per project basis. And so what you had was the buyer, when they bought the business, there was, you know, this mismatch between what they were quoting customers and what actually was the cost to do the work. And so your margins were off, your quotes were off, how much you were charging your end user was off. And so there was a lot of operational issues that came out of not recording your financials in an appropriate manner. And so I think, you know, as you guys look to buy businesses with a little bit of complexity in the accounting function, you can either see that as an opportunity or risk. It's likely both. And so really, when you can get in there, buy the business, and for that client, for example, we help them shore up their work in progress accounting post-close, and now all of a sudden they've got accounting, profitability by division, they have profitability by project, and they have profitability on a WIP on a monthly basis way more accurately. So now all of a sudden they're able to bid on projects with a lot more information than they were previously doing. So that's an example of where financial reporting oversight is extremely important. So getting into the other pillars of financial due diligence, proof of cash, that's usually the first step we're going to do in any financial due diligence project. And for those that don't know, proof of cash is when you are tying out what's actually hitting and leaving the bank statements to the presented financials. So it's going to be your revenue net of AR movement, expenses net of AP and CapEx movement, and does it match the bank statement? So it's more of a technical procedure, but it's really to get comfort over the financials and understand, okay, are these financials reliable? Because if we have mistakes here, and I'll tell you, okay, so most of the time the proof of cash works out relatively okay. Probably 85% of the time it's going to be fine because most business owners, they don't have, they monitor cash quite closely. And so they're, how they record cash and how they expense it. And they usually do cash financials. And so if you're doing cash financials, your proof of cash should match your cash financials. There shouldn't be a difference. And so we do see differences once in a while. And those are businesses with red flags that you probably need to run away from. And then obviously the adjusted EBITDA, net working capital, and the subsequent analysis is the bread and butter of the QV. It's why you get it done. It's to figure out, okay, what is my EBITDA and how much money do I need to run the business? That's your EBITDA net working capital. And then the rest of the schedules that we complete. And I'll show you guys, after this a few slides here, what a QV looks like from an Excel data book. I'm sure you guys some of you probably have seen what a PDF of it looks like, 45-page report, nice and fancy with headings. But the Excel data book is really where the meat is and really where you can see where the analysis is done and how it actually comes together versus what's actually put together at the end. So those are the pillars of financial due diligence. As you think of quality of earnings versus audit, I just want to clarify this too, because in the lower mid-market, and I always say lower mid-market because it's a different ball game in the SMB world versus mid-market and upper mid-market. So when people say quality of earnings, there is no unique and standard definition as to what a quality of earnings is. I've seen people go to their local tax accountant and spend 1 hour going over books and call it a quality of earnings. And then I've seen, when I was at Deloitte, Big Four reports that cost $150,000 that are quality of earnings that take, 3 months. So those are both called quality of earnings. It just means different things to different people. And so when you guys, look to get a quality of earnings done, you sign your LOI, you guys are ready to go, really understand what the service provider is talking about when they say quality of earnings, and really understand that everybody is on the same page. Because if you guys aren't, that's when you're going to have issues, and that's when there's going to be discrepancies. That's when there's going to be things that are deal killers. And that's where you might get swindled as a buyer thinking you got a quality of earnings done, and you actually didn't. And so post-close, you go in there, oh no, the books are a mess. What happened? This is probably what happened. So clarify that up front. And financial audit is different altogether. Financial audit and quality of earnings are not the same. Financial audit is you are just verifying previous historical statements with a certain materiality threshold. Quality of earnings is far more nuanced, far more consulting based, far more fluid, and it allows you to change procedures based on what you're seeing. It allows you to go in there, do different things, and really fit the business's needs. Whereas audit is very strict. You have to do certain things. You have to follow a certain procedure. There's very little room for flexibility there. So just wanted to point that out here. So as we get into quality of earnings, really, these are the main sections you're going to see. You're going to see an accounting process section, a summary, quality of earnings, the actual analysis on EBITDA, net working cap, and then your income statement, balance sheet analysis with your appendices. So I'm going to kind of go through this PDF report a little bit fast because I want to get to the actual Excel data book, show you guys what that looks like, and then I want to focus on real life stories, on things that we've seen in the market in the past, past 3 to 6 months and 6 to 9 months, so you guys have a better understanding of what's actually happening in the deal world, what deals are getting done and what's not getting done. So as you guys go through the executive summary, this is where we talk about the transaction, what's happening with it, all that fun stuff. Accounting process, controls. So this is a very important thing. in the lower mid market, most companies don't have adequate controls. And what I mean by control, I mean is who's doing the bank rec? Are they the same person reviewing the bank rec? Is the person who's doing the bank rec, are they the same person who's cutting checks and receiving deposits? All of that is heavy risk, right? We do it because we identify risks in the business. For example, if you have a bookkeeper who's doing the bank reconciliation, but they're also receiving deposits and cutting checks, well, that's not a safe control, is it, right? Because that bookkeeper has the ability to do the bank rec, but he also has the ability to collect deposits and write out checks to make sure the bank rec always matches. So that's risk for fraud because no one's verifying that information. So in most small businesses, there's going to be reliance on certain key individuals that have the ability to commit fraud. It's what it is, right? That business probably only has one bookkeeper, which is why they need them to do everything. But that also means that there's you as the buyer when you buy that business, you need to look at ways to change that or look at ways you can have better governance and oversight on the business. Because if you don't have segregation of duties, if you don't have proper review processes, you could be in for a bit of a hoop post close. And I'm not saying it happens all the time, but there are stories where buyers go in there and they find out there's been fraud in the business, there's been deceitful tactics applied, sellers have been unhonest. So really, we want to make sure we prevent that up front and we identify areas where there could be risk. So that's when we talk about the accounting process, revenue recognition and deferred revenue. When we do a QOV, this is probably a top 3 to 5 item that A is usually wrong and B is going to cause the most issues in your QOV EBITDA analysis. Any business that has deposits has deferred revenue. So if you see a business and it has deposits and you don't see deferred revenue on the balance sheet and you don't see accrual financial statements, that's not a red flag because it's common. I would say it's a yellow flag. The reason I say yellow is you need to be aware is my EBITDA is likely misstated. Whether under, whether over, we have to do a QV to find out, but it's likely misstated. So when you guys look at SIMs, you look at, okay, the business takes deposits, perfect. I don't see deferred revenue or I see cash financials, yellow flag. There could be something wrong with this business. I need to make sure I look at this post LOI, or at least I submit my LOI with the understanding that this can change. Revenue recognition. I talked about this kind of a little bit earlier. When you have work in progress, when you have deposits, when you have scheduled payments, when you have delivery of goods and installation and warranty and all these other things that happen in a business, revenue recognition is likely going to be wrong from the seller. A seller, what they do most of the time is cash hits the bank, I earned revenue. Perfect. Keep it simple. They own the business. They own 100% of it. They're just submitting their taxes for cash purposes. Fine. You as a buyer, you guys can't afford that mistake. It's very likely your revenue recognition is wrong. So when we do a QV, we always want to make sure we understand when are the performance obligations, is what we call, when are they satisfied? When have we earned the revenue? And does that match with what we've recorded? So earned revenue is very important in QVs for lower mid-market. Most people get it wrong. Most businesses get it wrong. And it's going to be one of the larger reasons as to why your EBITDA comes back 10, 20, 30% lower. It's going to be revenue recognition. Cost of sales, obviously, that's another one. I'm not going to spend too much time on it, but just know a lot of businesses, any business with inventory, okay? If you see a business and you have inventory, you have staff that work in labor hours that are building machines, CNC machine shops, all that. Do their time go in the cost of sales? Is inventory held on the balance sheet? First of all, we've seen last year we saw a deal. It's about 6 million in EBITDA. So a large business, which what they do is as soon as inventory comes in the door, they expense it through the profit and loss. Nothing's held on the balance sheet. Why do they do that? Because that reduces their taxes and reduces their net income. Because they're expensing all their P&L, they're not holding anything on the balance sheet. Now all of a sudden they want to sell their business. Great. Well, their COGS is overstated, their EBITDA is understated. So now we need to go and do reconciliation on cost of sales against margins through all their historical sales in order to figure out what is their true gross margin and what is their true cost of sales and what's really the EBITDA. So really, you guys see inventory or you guys see accounts that should be on the cost of sales side. This is another large mistake the small businesses make, and a lot of times it's going to be a cause of renegotiation here. So as we get into what a quality of earnings actually looks like on the back end, this is sort of what you should expect to see as sort of a deliverable. Now, this sample report has 18 adjustments. That's not always the case. I'll tell you guys, on average, for a small deal, I would expect around 8 adjustments to quality of earnings or to the EBITDA. The highest I've seen is 20, 24. Lowest I've seen is probably 3. So you expect at least 3. Average is probably 8 to 9. Highest I've seen is like mid-20s. So really, when you're looking at this quality of earnings, the goal of this is to reconcile our revenue, what's reported, what's definitionally our EBITDA, and where are we at the diligence adjusted EBITDA. And then we go through the commentary of each expense and why it's been adjusted to EBITDA and why it's been there. So that's a quick high level of what you can expect from the QV perspective. Net working capital. Net working capital in transactions I'm saying top 5 a lot, but this is probably top 3 or top 2 reasons why deals die is net working capital peg. Everybody, lawyers, sellers, buyers, brokers, investment banks, everyone is kind of loves this topic or hates this topic. And the reason why is because it's so important in the deal. And if it's not addressed early enough, it's going to kill your deal. If you submit an LOI and you don't put anything around net working capital or you don't have a conversation with the seller early enough, you're going to have issues closing that deal. You're going to have issues as you get to the end. So net working capital, what does it mean by definition? By definition, it's current assets minus current liabilities. But how we treat it in an M&A transaction changes a little bit. So I'll give you guys an example. We did a transaction where the seller went to their tax accountant and told them to put together a net working capital schedule. Perfect. The seller's tax accountant did current assets minus current liabilities, did an average, and said, this is your net working capital, 200,000. I think it was like 300,000 actually. Now, when we did our net working capital calculation, we got 2.1 million. What was the difference? The difference was, you see this number called debt-free? Well, when you're doing a transaction in the M&A world, all your transactions are going to be debt-free, cash-free. And so what the seller was doing in this case, they had a line of credit. Technically, a line of credit is a current liability. The seller's tax accountant said their line of credit reduces their net working capital. Great. So they don't have a high working capital need. Well, that's completely wrong, because when we calculate working capital, we remove all debt-like items. So we remove deferred revenue, we remove lines of credit, we remove bank indebtedness, and for the current assets, we remove cash. And then we get our net working capital number. And then we also have to do a peg on this. Yeah, can I have a question?
Sorry, to help me put this in perspective, like, what was the size of this deal? Because you're saying like 2.1 million, and I'm like, oof, that's a bit more than what I'm willing to pay for a deal. So just, can you help me put this into perspective for us?
Yeah, this one was 8.7 million, the transaction, with some earn-out clauses. So I'd say closer to 10 million. But this was a heavy work in progress business. And the reason why is they had city contracts. So they were doing they were in the state of Maryland. And so basically their accounts receivable was like 2.5 million, just their AR, because they would get paid, they do projects and they don't get paid till they finish the entire thing. And they had, they'd submit their invoices to the city would take 6 months to get back to them. So they had an abnormally large working capital need, but it's because of the structure of their contracts and who they were working with. So they didn't have a risk of, bad debt, but they had heavy working capital because it just took so long to pay.
Okay. Thanks.
Yeah, of course. And the other reason was they had I talked about it earlier, work in progress. They had a massive work in progress account because they would do all these contracts. And like I said, they got paid in milestones and near the end. So they'd have to, and then they also had retainage on their projects. So 10% of whatever they were getting paid was getting held back in retainage. So they had a lot of accounts that were causing the working capital to be so high. And that's why they had lines of credit on the business. For business that was doing, I think, 2.5 million in EBITDA, they still have lines of credit. And so you think, okay, why is that the case? Well, it's because their working capital need is so high. And so that's just an example of where there was such a large delta between what the seller expected and what we expected. And then in the flip side, when we do smaller deals all the time, when wheels come in, we'll say it's 500K or 200K, and the seller says, no, it's 100K or 50K. There's always differences when we try to negotiate net working capital. In the end, we try to find some sort of middle ground that works for everybody to make sure that when you guys buy that business, you're not going in there and buying something with no gas, and you have to fund payroll for the first 60 days and fund operations for the first 180, and basically you're adding another 600K to purchase price on money you're never going to see again. So that's why the net working capital peg and transaction are so important. It's important in every deal of every size because that's real dollars. I always tell people, listen, if I tell you the working capital is 1.3, you can go out and buy that business for 800K in working capital with 800K, sorry. But I promise you that 500K difference, you're going to have to bridge that gap. And that's money you're never going to see until you sell the business or you dissolve the business. And so that's real money that's gone from you basically forever because it's always going to be stuck in that cycle. And there's been deals where we've closed and that's happened and that's been reality, but the buyers just are okay with that and that's fine. But as long as like you have to know that going into it, because if you're caught on the wrong side early on and you miss payroll and you miss rent and there's a deal we're doing now where there's 6 locations. It's a franchisee business that's being carved out. Each location. So when we're doing the QV, the franchisor has they said there's no net working capital needs, small inventory, great. Well, okay, we have 6 locations. Each location wants a security deposit of 10 or 15 grand. Each location wants first and last month's rent. Each location wants, some locations, 2 of them, they're premium ones, wants 3 months rent in advance. Okay, well now all of a sudden you got over 100K just stuck in the security deposit and rents across the 6 locations. And so that's a real life example. Another one we're doing now where, we got to come up with 100+ grand just to pay these leases or have them, get the money into these leases. And so that's another scenario where it's not something you would think about really when you're buying a business is like, oh, now all of a sudden I pay security deposits. Insurance, for example, this business, I was like, okay, well, you're going to buy this business, you're going to get insurance. The insurance is going to be over 100 grand. Well, do they want it all paid up front? Okay, well, there you go. That's another 100 grand you have to come out with that close. And so this is where things start to add up, right? And, first month's payroll, like what's their payroll structure? Businesses with subcontractors, they get paid every week. Businesses with payroll, that's every 2 weeks. You can't miss that. And so a lot of times you have to go through these cycles a few times. And so kind of getting into the next thing we do in the QV is when we do this is what is your cash conversion cycle? How long does it take you to actually see cash come through the door from start to finish of work, start to finish of accounts receivable, inventory? And so that's an important part when we figure out our net working capital peg is how does it tie to cash conversion cycle? And then what does that mean for you really at the end of the day? And then businesses that are growing, businesses that are shrinking, if they're not stable, this calculation becomes even more important because what you pick as your working capital peg, 12 months, 6 month, 3 month, that changes. So we want to make sure we're on the same page for that. So as we go through cash conversion cycle, I'm going to kind of go a little bit faster so I can get to a few of the other topics. Is gross margin. It's absolutely important. Anytime you see large fluctuations in gross margin, the books are either going to be wrong or recorded incorrectly. So always keep track of gross margin. Significant customers, I'm sure you guys have dealt with this yourselves, this is a huge deal killer, high customer concentration. Every time we do a deal, we care is on the customer concentration side, what are their macroeconomic environment look like? What are their operations look like? If you're tied to 3 or 4 customers, you better make sure those 3 or 4 customers don't have any downwind pressure or don't have any tailwinds affecting their business. If you're tied to 3 or 4 customers, we saw a deal recently where there was, it looked like it's 5 different customers, and then you kind of look under the hood a little bit. All of a sudden, you realize they're owned by a similar group of companies, and it all filters back up to 2 guys. And all of a sudden, you go from 5 or 6 customers. Well, it's actually just 1 or 2. And so that starts to change things a little bit as well. So we really want to make sure we break that down. We break down all your expenses, explain them to you, help you understand, and same for the balance sheet on the quality of asset side. And then obviously we have our appendices, we have recommendations and all the stuff we do. So this is kind of the 50-page report that you'll get for as part of the QV should you do this option. I'm going to change directions a little bit and show you guys what a QV looks like from a Excel data book perspective. And the reason I say this is because when we look at an Excel data book, you can start to visualize how we take the data and what we do with it. Matt, you have a question?
Yeah, and I may be going into one of these really soon. So as you find some of those errors, and obviously it can change the true EBITDA of it, how does that affect the business valuation, or do you make a recommendation there, or is that something we do separately? Like, how does this all tie in?
Yeah, absolutely. So we would make a recommendation of business valuation if the materiality is met. So when I say materiality, is I'll give you an example. We did a deal recently where there was a 400K adjustment that was just materially wrong. The seller just basically added it back when it shouldn't even be there. I would argue that's a full adjustment to purchase price because that's a flat out mistake from a seller, and there's no gray area. It's black and white. And so that's a scenario where we went back and we recommended a seller like, hey, I think your true EBITDA is this number. Based on your debt and equity stack, you need to adjust the purchase price because this is not working. And then that's something that happened recently. And then in other scenarios, we might come back and say, listen, I think you know, when you buy the business, your insurance is going to change a little bit. You're going to be paying a premium. Okay, the seller might come back and say, well, that's not my problem. And the buyer might say, well, that kind of is. And so this is where it gets a little bit more negotiation style, right? Well, I'm going to be buying the business. You're saying it's $1 million EBITDA, for me, it's 900 because my insurance is higher. Seller is going to say, well, it's $1 million EBITDA business. Just because you're paying higher insurance, it's not up to me, blah, blah, blah. So that's where it becomes a little bit more of a gray area negotiation. But every time we do this, our goal is to get you to this diligence adjusted EBITDA number based off of our normalizations. And really, if that number is within our range, and when I say ours, it's mine and Matt, if you're my client, in that case, it's you and I will say, okay, does this still make sense? If the EBITDA is 2.9, when it's presented as 3.1, does that still make sense for this transaction? Does that still make sense with your debt and equity stack? And are you willing to pay that multiple on that purchase price? And if the answer is yes, okay, fine, we can stomach it. If it's not, well, let's go back to seller and figure out, can we do some earnout? Can we do a little bit more seller note or more forgivable seller note based on customer concentration? And how do we bridge that gap? And so that always happens. I would say, and to give you guys an example, I would say on our QVs last year, on those 50 plus transactions we did, about half of them come back clean, about 45 to 50%. I would say 20 to 25 come back with pretty major mistakes that are deal killers and we can't proceed. And then the other 20% are this gray area where there's downward pressure, EBITDA is down or something, we have to renegotiate and we have to go back to the drawing board and figure out a creative way to make it work. And so those are kind of the sort of like breakdowns in terms of percentages and what to expect. But yeah, we're always involved in that process. I mean, networking capital negotiations, purchase price reductions, things like that. We're heavily involved in that.
Great, thank you.
Yeah, of course. So this is an example of what a QV looks like from a summary and detailed lens. And this, I want to show you guys this because this is actually like what we look at. The PDF is great. I don't really look at the PDF, put it together, great. I look at what's the actual detail, right? So the first thing we want is monthly P&Ls. This is so important, and I want to emphasize this to you guys. Everyone cares about yearly, annually. Monthly is far more important because when you start to see EBITDA fluctuate month to month, like this one month is 500, 1 month is 1.3, 1 month's negative 150. Like, what is happening, right? You have to understand these, and this goes back to our net working capital. If you're buying the business at the end of this month and the first month you do negative 150, well, you're going to be waiting for this month to make your money. You have to understand, why is that the case? Why is that happening, right? And so really, when we do a QV, monthly P&Ls and monthly adjustments are far more important than anything else. Like, this tab is far more important than anything that we do. And we get to our our diligence adjusted EBITDA on a monthly basis, and you need to make sure the day you're buying that business or when you're buying that business, is their bonus paid out the day after you buy that business? Well, better make sure that's in your net debt schedule, and you're giving that to the seller. Are you buying the business when it's high PTO season? Are you assuming PTO for the employees that you have in the business, or is the seller paying off that PTO? The day you're buying the business, is there a large payment to a large vendor coming up? Make sure it's calculated in your net working capital peg. So all that stuff, when we talk about monthlies, is far more important than anything else we do. This deal was a little bit unique. There was a huge project that had this massive revenue swing or EBITDA swing that was causing some issues for us. And you can see you got reliable, unreliable. Why is it wrong? Revenue is reliable, costs are unreliable, breakdown as to what's happening. So really, this is the analysis that happens behind the screen, right? What's happening behind closed doors that you guys don't see, that we work on our end, and to get you guys, comfortable with the decision and the deal that you're buying. And so you can see there's quite a bit of stuff. And when I say net working capital, this is kind of going back to here. So this is, you can see averages and kind of what we're doing to get to our number here, based off our kind of our analysis. And so this is the net working capital detail, where you can see all the adjustments we make on our end, why they're made, and getting an adjusted debt-free, cash-free net working capital number. And as we go into, you can see the cash conversion cycle. I was telling you guys about how we get that into, when you guys get paid net debt. You want to make sure, like I said, PTO, deferred revenue, anything that's considered net debt or debt-like, make sure you remove it and the seller pays for this and not you guys, because this is just an added cost in the deal if you don't take care of this. Payroll overview, you want to make sure you've got unionized. This one had unionized employees. Okay, so now we've got a bit of an issue. Make sure your W-2, your 1099s are appropriately recorded, union, non-union, make sure it's all captured. And then what are the operational implications of having issues with their union W-2s and 1099 employees? We've got that all settled out here. And external verifications, how do we actually verify the financials? Take the tax returns, tie it up to the financials, make the notes, make a nice chart so we can see, does it all make sense? We sample accounts receivable items, check, like this one is a construction business that retention, but make sure our revenue matches our AR, matches our cash date, matches our bank statement, and all that fun stuff. And then obviously our proof of cash, you can see it's a little bit in depth, but we want to make sure our receipts and our disbursements all match each other. So really, this is kind of like what a QB looks like behind the lens, and the amount of work you can see in all the tabs and stuff that we do that goes into it, that helps you understand, okay, what are we looking at when we buy this business? And so that's the QV and really what it looks like. I'm now going to jump into a few war stories, because I think this is important for you guys to hear. These are probably all in the last, I think, 6 months on items where, and I'm going to go through them pretty quickly, and then I'll give you guys about 10-15 minutes at the end here to ask questions and talk about anything you guys have here. So, war story, revenue booked on purchase order. So we did a deal. This was an e-commerce business, and basically the seller, what they had done is they received a PO from a large customer. Amazing. They recorded credit revenue $125,000, debit accounts receivable $125,000. We look at the AR aging and go through their revenue. I was like, hey, listen, this AR has been outstanding for 6 months. Like, are they paying you guys? Like, oh no, we haven't invoiced them yet. Okay, well, we haven't invoiced them yet. Why is it accounts receivable? Well, it's a PO. Great. That's completely false. That's completely wrong. Overstated EBITDA. This deal was only about $425K in EBITDA. This transaction was about 125. Well, that's over 25% of your EBITDA, or 20%. This deal died on the spot, basically, as soon as we figured this out. So again, this happens in the small SMB world. You'll see POs recorded as revenue, or some sort of, when I talk about revenue recognition, this is one of the things that we look at in a situation where, there was just a flat out mistake. Invalid payroll add back. So this was a deal in November of 2025, so about 4 months ago. This business was about 3.2 million in EBITDA. And what the seller had done is they added back payroll costs for their family. Amazing, great, their own payroll costs. They don't work in the business. Okay, fine. We can talk about that secondary. But They added back about 500K to get to 3.2. So their EBITDA was 2.7 before these add backs, 3.2 with the add backs. What the issue was is the payroll add backs the seller had made on their sim with the broker were actually not in the P&L. The tax accountant at year end, so if you take their payroll report, you'll see the sellers getting paid, all that stuff. So they're real payroll items. But what happens is the tax accountant at year end makes that adjustment to distributions. So this item has already been taken out of the P&L. The seller didn't know that. The seller double counted it basically and added it back. That was a 500K adjustment. And it was just flat out mistake that they made. And so this was a massive one. This deal is under renegotiation right now. So I think they're still going to close, but there was definitely a lot of trust loss and a lot of months lost trying to figure out how to bridge a $500,000 gap, especially for the buyers in this case. So that was another story. Seller refused to leave working capital. There's probably 7 of these, but I can tell you guys, one recently where it was as a business does like fencing and sort of in that construction and landscaping space where the seller basically said they're not going to leave any net working capital back. We said that the buyer needed about, I think it was around 550K on this one. And really what happened is deal just died. Buyers, I'm not comfortable putting an extra $600,000 in this business at this valuation. Seller was not budging. That was the end of that deal, right? Had they had this conversation early on, we probably could have stopped it. Unfortunately, it wasn't the case, miscommunication and things like that. And so, and then I have another story for you guys on this working capital. And this was probably an oversight on our part as well. This was about a year and a half ago where we did a transaction and I presented my net working capital schedule to you guys. The net working capital tab I showed you in the Excel. I presented that to the seller. I said, listen, the net working capital of this business is $750,000. That's what we need at close. That's what should come with the business. Seller's like, yep, I agree. Okay, well, that makes sense to me. Makes sense to me. Buyers like, makes sense to me. Broker says, makes sense to me. 2 days before closing, seller says 750,000. No, we never talked about that. I said in the sim, I'm leaving 150. That's the number I'm leaving. Well, I said, yeah, well, I did that presentation and then the buyer, you guys were all on it. We said 750. He's like, yeah, I agree. It needs 750, but that's what I thought we were talking about. I'm not leaving 750. Oh, okay. This is 2 days before closing. And this was a major, major thing, right? The buyer still ended up buying the business. They were a public company, so they had a little bit more capital and they were buying it for strategic reasons. But that was not a fun conversation to be in, right? And I think that's where I realized, well, you can present things to sellers. Sellers are old school. They might not understand financial metrics. I think we need to, so now moving forward, anytime we do a working capital meeting, seller, I send a huge email, bold out, what does this mean? This means you leave this much in the business. And so when you guys have those conversations with sellers, you guys are probably going out to dinner with the seller's family, informal conversations. I think anytime you talk things through, you need to help the seller understand what are the implications of the conversation you're having. Because that was one where we thought we were all having that same conversation, but we all left with wildly different interpretations of how that thing went. And so that's where having just having it written out a little bit more clear would have been beneficial. So that's another war story on working capital. Deferred revenue. This is another massive one where seller had sold prepaid subscriptions prior to close. So they were a subscription business that sold 6 months. This was a med spa business. So I think they even had 3-year subscriptions. So they probably had 750,000 in deferred revenue collected up front for clients that they hadn't done the work on. So, and basically they wanted to walk away with that money. They thought they were entitled to it. They were only willing to leave like 10%. They said, it's my money. I brought in the customer. Well, all of a sudden, okay, you take that money. If I'm the buyer, who has to service these customers? It's going to be me, right? Post-close. And so this happens quite frequently. And we're doing another 2 deals right now actively where deferred revenue is a massive topic. And really, it's just like gift card liabilities. Okay, where's the real deferred revenue numbers? How are we calculating it? we're doing one. It's it's like a studio that offers classes. It's like, how do you discount 10 classes versus 5? And so there's a lot of nuances when you have deferred revenue. It's a massive deal killer. So if you have a deferred revenue business, please get ahead of it and make sure you have that conversation with the seller, and make sure you're taking some cash retained, because if you take a deferred revenue business and you buy it with no cash retained, you guys are going to be in for a hoop. Construction of WIP and percentage of completion errors. So we talked about this a little bit earlier, but I will tell you, I think most small businesses get this wrong. Percentage of completion is an appropriate rev rec method. You're allowed to do it under GAAP. The issue with is you have to make sure you track your costs correctly. Otherwise, this number is going to be wrong. And I'll give you guys more of a example that's not SMB, but I could tell you how large companies manipulate this. So you guys remember during COVID, you guys had the PPP loans, and governments were giving money based off of, every country was doing it. They were giving money based off of revenue drops month over month comparison. So the March 2020 to March 2019. What construction businesses did, which I think a lot of them did, is they would not record any percentage of completion for the month, and they'd show a massive $2 million drop in revenue or EBITDA. They get these huge PPP loans. The next month they have record months all preceding. And all of a sudden you're like, okay, like how did that happen? Well, they messed around percentage of completion, right? If you're a construction business and you're doing these massive, massive towers, if you say it's 60% complete or 65% complete, it's going to be very hard for someone to come in and check all the costs to make sure that's right month over month. You could do it year over year because you have procedures, but month over month you can't. And that's where you have these huge errors in percentage of completion that cause these loans to be manipulated. And that's, I use that as an example, but that also happens now at closing with sellers. Well, they have percentage of completion and WIP. Well, it's probably going to be wrong, right? And so anything with construction, WIP, retainage, percentage of completion, it's going to be, it's very likely going to cause EBITDA drops. So make sure you guys get ahead of this if you have this in your deal. So we've got about 10-15 minutes left here. I'm gonna pause now after talking all the way through here. I'll open the floor up to you guys here if you have any specific deal questions about the presentation, some of these war stories, or basically anything deal related.
If you go through this and you come back with something that's not in the seller's favor, do they typically then have like their accountant go and try to put it back in their favor and argue essentially with whatever you come up with? Like, how does that typically go back and forth?
Yeah, so they do. So here's the issue. A lot of the sellers' accountants are their tax accountants. And so when they're doing a transaction, they might do one a year, probably not even, right? And so their knowledge on how to negotiate some of these things is not very strong. And so this is where you start to have, like, for myself, for example, where I have to go through the seller's accountant, talk to them, help them understand. They help their client understand. So it's a little bit more of a roundabout procedure, but they try to do that all the time. Yeah, you'll say, oh, my CPA said this, and I get their CPA on the phone. I'm like, no, it doesn't make sense, because the current asset example, for example, right? The one I told you where they thought they could include line of credit as a current liability when that's not the case. And so that's an example where they tried to fight back a little bit, but it didn't work out. The only time it's a little bit harder is when the seller does their own QV. So they have someone like me doing a sell side QV, and they've already gone through this process, and then we have differences. Then it gets a little bit more challenging to push back. And we're doing that right now with one where we're the seller and the buyer's QV is, trying to change some things, and we're like, nope, it doesn't work like that. So it does happen. That's the beauty of deal work, or the annoying part about deal work. Every deal is just so different. Every person is different, and this is where dealing with personalities, seller's personality, making sure you're not the deal killer in the space, but you're protecting your client and your buyer in this instance. So it's always tricky. You're always kind of walking on water, but just gotta kind of deal with it as it comes. But just make sure that your buyer's protected, or at least aware of the implications of everything that's happening.
Thank you.
Anyone else have anything here?
Maybe just generically, Avnet, what do you think if you wanted to minimize probability of these kinds of errors, what kind of business would you focus on?
Yeah, I think like the businesses that I've seen that are cleanest, for example, are businesses that have recurring monthly revenue that's easily tiable to third parties. So, for example, business with Shopify revenue, e-commerce business where it's, or like SaaS businesses that are directly tied to a third party platform that records their revenue for them. So Shopify, WooCommerce, all that stuff. The issue with that is I don't think it's a good idea to try buy business to limit your chance of error in this case, because you might buy something that's not a great fit. For example, if you're not a SaaS background and you don't love those type of businesses, then it probably doesn't make sense to buy it just because there's a chance of less mistakes. But yeah, generally businesses without inventory are easier, just naturally easier, A, operationally, and B, less financial opportunity for mistakes. Businesses with no deferred revenue, same thing. But then also on the flip side, deferred revenue helps your working capital situation. So you do want some of that. Businesses with low AR, they get paid basically as you deliver the service. For example, if you own a store, they give you the money, there's no accounts receivable, great. Businesses without heavy capex, there's no heavy machinery, there's no work in progress, there's no labor. All those are inherently easier from a QV perspective. But again, I think finding something that fits for you better from an operational, and let your QV provider or let your experts deal with this stuff that we talked about here.
Yeah, I mean, it sounds like there are levels to these errors. Like some are, complete deal breakers. Some can be worked around.
Yeah.
Like what you're talking about with, what you have on screen here and deferred revenue, this kind of thing. It sounds like those are more frequently deal breakers. Would you agree?
Yeah. So deferred revenue is more frequently a deal breaker. Construction and WIP is more frequently. So like there's deal breakers that aren't listed here that are very infrequent. But these are the more frequent ones, everything kind of that I've been trying to pinpoint based off of all the deals that we've done. These are the areas that, okay, we got to heavily zone in on. So when someone comes to me for a QV quote, the first thing I do is I look at, okay, what are the accounts in the balance sheet? How does the business operate? Look at the general ledger if I can. And then I start to understand, okay, I think the mistakes are going to be in these 7 areas. And then these 3 might be fine. So yeah, like I said, there's, half the deals end up being fine. The other half, 25, there's retrades and some, sort of repricing. And the other 25, they're just complete deal killers.
All right, thank you.
Yep.
All right, I think, oh, sorry. Is there anyone who has any further questions? Well, I think that's about it. We still have 7 minutes. We'll just give back your time, guys. And if you have any further questions, feel free to email Avnit, or feel free to reach out to me so at least I can provide Avnit's contact information.
Thank
Yeah,
you.
perfect.
Thanks, Andy. Thanks, Avnit.
All right, cool. Well, thanks everyone again, and yeah, happy Monday.
Yeah,
Thanks,
Yeah,
Avnit.
thanks everyone. Yeah, feel free to reach out if you have any questions. Thanks everyone.
will do.